Welcome to Thoughts on the Market. I'm Michael Zezas, Head of Public Policy Research and Municipal Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between U.S. public policy and financial markets. It's Tuesday, August 10th at 1 p.m. in New York. With the Senate set to join the House later this week on recess, we turn our attention from domestic to international affairs. This morning, we hosted a webcast with key experts on the relationship between the U.S. and China. That relationship in many ways drove markets in 2018 and 2019 as the powers engaged in a confrontation over trade policy, leading to substantial increases in tariffs. COVID created a break in that dynamic, but we think the relationship could return to the forefront of investors' minds over the rest of this year and next. Here are our top 3 takeaways from the webcast earlier today. First, our panelists say plenty of catalysts to drive headlines of U.S. China tensions are on the horizon. The coming weeks could see some details of the U.S.'s study into the origins of COVID-19 leak into press headlines. The Winter Olympics in Beijing, only about 6 months away, could be preceded by calls for U.S. companies to boycott sponsorship. And of course, 2022 is a midterm election year in the U.S., and given polling showing widespread mistrust of China by voters across party lines, expect both political parties to employ hawkish rhetoric about the U.S. relationship with China. Second, our panelists don't think investors or the business community should hold out hope of a speedy reduction in the tariffs that were raised between the U.S. and China in 2018 and 2019. China continues to fall short on its asset purchase commitments under the Phase 1 deal, and the U.S. is taking its time deciding how it wants to engage to try and achieve the goals that were deferred to Phase 2, including tough items like subsidies to state-owned enterprises. Rather, the U.S. appears interested in playing more aggressive offense through legislation, with the Biden administration focused on infrastructure and the U.S. ICA as cornerstones of its economic strategy towards China. Third, companies should continue to prepare for a world where the U.S. and China economies have even more rules of engagement, increasing transaction costs for doing business with one another. That could take the form of non-tariff barriers like rules regulating customer data collection, something that today may only seem like an issue for internet companies, but could become costly for more traditional industries like automobiles. It could also take the form of restrictions on investment. Such restrictions are common for Chinese companies looking to purchase U.S. assets and technology, but could become more common for outbound investments from U.S. companies to China. In short, the U.S.-China dynamic continues to be a complicated one defined increasingly by competition rather than cooperation. And the implications for global markets will be myriad as key industries adjust their market strategies. For those wanting to learn more, check out our guide to investing in the multipolar world, which you can find at morganstanley.com. Thanks for listening. If you enjoy the show, please share Thoughts on the Market with a friend or colleague, or leave us a review on Apple Podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.